Good morning. Welcome to Stock Market Today. It's Tuesday, October 20th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter, as always, at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities lower on Monday, fading late in the session. Remember early when we were recording this show yesterday, futures were up about 1%. They closed the day down about 1.5% as there's only one way to describe it. Lucy pulled the football again, right? Dangling that hope of stimulus pre-election. It gets people excited, and then when it looks like it's not going to materialize, they sell off. All sectors closed in the red. Utilities outperformed, while energy was the worst of the bunch. Treasuries mostly weaker, putting on the bear steepener yesterday. Dollar weakened against the euro, and sterling gained against the yen. Gold was up 30 basis points. WTI crude finished down about 10 basis points on the day. Now, as we get to this desk this morning, the evergreen hopes of stimulus are there once again. S&P futures up about 60 basis points, and that's after Asian markets finished mixed overnight. China outperforming Japan and Taiwan to the downside. European markets are mostly higher. Treasuries are mostly weaker with the curve steepening, so the bear steepener still being put on. Dollar is stronger against the yen, but weaker against the euro and sterling. Gold down 30 bips. WTI crude is down 40 bips. Now, just a highlight or just a reminder, stimulus pre-election was never our base case. We've always viewed it simply as an upside kicker. So to us, when we started to get more constructive on the market back in the mid to late September timeframe, stimulus was the upside kicker. So to me, if you're there, you've been putting positions on, or you were putting positions on, now you're just kind of riding the wave. We've talked about the fact that our indicators have been overbought, but we're above support. So what we're looking for to put more money to work are oversold conditions above support. In the meantime, I don't see anything to get excited about one way or the other. And by excited, I mean getting worked up about stimulus. I mean, it just doesn't make any sense to me whatsoever. It's largely a function. If you're whipping back and forth on stimulus headlines, it's largely a function of not having a plan at all. So let's dive in, right? So as I said, Lucy pulls the football one more time, right? I just keep coming back to that comic, Charlie Brown going to kick the football and Lucy pulling it away on the stimulus here. Faded throughout the day. But what we care about is that the key levels so far have held. We're still above key levels, and we've been giving them to you. You know them, you love them, you have them ingrained in your head for now. SPY, it's 340, Qs, it's 280, IWM, it's 160, all still within striking distance of 52-week highs, right? So go back and say to yourself, if you zoom out and just look at these charts, right? Turn off the headlines for a moment. The headlines are interesting. We read the news, everybody's paying attention. But when you're making your investment decisions, it's a pretty simple one. Are we above key levels? Yes. Are we overbought? Yes. So are we aggressive? No. Let's look for oversold while still above key levels to get aggressive, right? Otherwise, what are you doing? You're buying stimulus hopes and then you're selling and then you're fading them. It makes no sense to me. The time to be constructive was down here when we said, it made sense to redeploy capital. Now you're just kind of watching them. You have your positions on, you're riding the wave. If they're working, that's great. If they're not, your stops kick in. You build up cash. Then when the market becomes oversold, if it's still above these key levels, you have cash to deploy. I see it as a very simple process. Hopefully you do too. Let's hit our market in a minute. What are we writing about today? Well, stocks reverse early gains. We've talked about that ad nauseum. Get that image in your head. Lucy, football, Charlie Brown, miss. All right. Technology and discretionary are bullish trends that are extended. Those are market leadership. They're just extended in the near term. We don't want to chase strength. We're waiting for those oversold conditions. Materials and industrials remain emerging relative strength, right? So that's been a theme that we've talked about for quite some time, and it remains in place. What I'm wondering is, why are utilities coming on strong, especially on a relative basis? And as I said, futures point to a higher open today as maybe Lucy has the football again. I don't know. Let's look at the power bars for the major indices. Dow down 1.3%, 2 to 6. Big shift in the power bar ratio for the Dow yesterday. 2 to 6 bulls to bears there. S&P 500 down 1.5%, 125 to 83 bulls to bears. The Nas another shift down 1.6, 25 to 13 bulls to bears. Small caps, I guess we can call them a slight outperformer. Only down 1.17, 744 to 261 bulls to bears there. Bonds down tick, send yields higher. That's the bear steepener. And according to the Chaikin power bar, small cap stocks and large cap stocks are bullish across the board. However, major markets are mixed. Let's hit our stocks of the day. So what I wanted to do here today, the rationale behind today's screen, and it's in my note, is to say for the past 5 days or so, we've been choppy. 5 trading days. We've been choppy. We know we're overbought. We know we're holding above key support. So what I wanted to do is look for relative strength, and in particular, technical relative strength, right? So what I'm screening for here, taking the Russell 3000, I'm looking for very bullish names with bullish technicals in our model that are above short-term trend line, our 21-day EMA, our long-term trend line with strong money flow and strong relative strength. Okay, you can kind of picture what that looks like. Those are stocks and uptrends that are outperforming the market. So as the market consolidates and then works towards an oversold condition, this would be the first place I go to look for ideas. All right. So 57 names here. Take a screenshot of this and add these names to a watch list. You can see some favorites here. Lennar, right? ADM, part of our ag theme. A lot of interesting names here that go beyond the fan mag, right? So take a look at these, add them to a list. Get them on a watch list and look for opportunities when the market is closer to oversold. I think the opportunities are going to be there. So this is an interesting screen that I've put together here today. I hope you find it useful. Let's take a look at our sector tracker now. Movement of the major sectors over the last 5 days. We've certainly swung, right? We've had some choppy trading. Everything down, all red over the last 5 days, with utilities at the top of the list. So that's interesting to me. I'm still trying to wrap my head around what that means. Is it defensive positioning in the equity markets, or is it stable dividend yield in an environment where dividends are at risk and we also have yields backing up in the treasury market? I don't know the answer. I'm going to watch it and look for clues. And the clues will be in the form of staples. If staples begin to outperform as well, then you have to start saying to yourself, okay, this is defensive positioning, right? The clues will also come if our support levels start to break. So we're watching closely. Industrials, materials, and staples all outperforming over the last 5 days of trading. Healthcare, discretionary, fins and comms, middle of the road. Tech, REITs, energy, bottom of the list. Energy should, I don't want to say this but I feel like energy should just take up permanent residence at the bottom of the list. But it's been a mess. We've been all over it. So I want it to change. I really do. But the market doesn't care what I want. So let's move on to our industry in focus, retail services. Past 6 months, been a monster, outperforming the S&P 500 by 24.7%. Has a strong power bar ratio, 32 to 12 bulls to bears, currently ranked number 10 of 21 subsectors. Names like LAD, Lithium Motors, Big Lots, BIG, and Asbury, ABG, Automotive, all with very bullish Chaikin power gauge ratings. And all are members of a fund that looks like this, right? This is, contrast this with some of the energy names that the energy ETFs that we've been looking at recently. Up and to the right is Bullish. You don't need a CMT after your name to figure that out. Bullish ETF rating 32 to 12 bulls to bears, strong trend above a rising long-term trend line, trading pretty much, we were at 52-week highs 2 days ago. Bullish money flow. So, if this was a stock, what would I say about it? If it was a stock, I'd say this is a great stock. Trend is up, bullish rating, outperforming, bullish money flow. Only issue I have in the near term is that it's overbought, similar to what we've been saying about the markets in general. So, ideal world, hold the breakout level, become oversold, start looking for opportunities. Market doesn't care what we think is an ideal world, so we're obviously going to have to stay nimble and dynamic, but that's how it would play out in an ideal world. It may or may not, but regardless, we want them when they're oversold, not when they're overbought. Let's take a look at what's trending now. Yesterday's S&P 500 gainers and losers, our movers and shakers. So the chatter yesterday was that Intel was going to unload its NAND business. Confirmed this morning, SK Hynix the buyer of Intel's NAND biz for about $9 billion. But that chatter yesterday benefited some of the HDD and other storage companies. So Western Digital, in particular, up 7.9% on that news. Micron goes along for the line ride on a similar theme. They're at the bottom of the gainers board, up 2%. UAL, nothing company specific to drive that stock higher by nearly 4%. TPR, no news yesterday, but Wells Fargo took their numbers up today. That stock was up 2.7% yesterday. UAA up 2%, nothing company specific to drive the flow there. On the loser side of the board, Ross Stores, no news, down 4.3%. Didn't see anything there. Gartner, IT, didn't see any news on that front either, down 4.3%. Wells Fargo, WFC, VF Corp, VFC, downgraded at BAML, Bank of America Merrill Lynch, took 4% out of that stock. FANG, just chalking into the energy bucket. And the REITs were under pressure yesterday. VNO downgraded at Evercore ISI. So that weighed on that stock. So it's kind of interesting to me that, in an environment where you would think maybe people were looking for opportunities, nope, one of the more reputable shops on the street from a research perspective is actually downgrading these REITs. So that's kind of interesting. Let's look at the trends now. That's why we're here. Tuesday is a relative strength day at Chaikin Analytics. My note does a deep dive on the sectors from a relative perspective. And I guess what I would say is not much has changed. The trends that are in place remain in place with some subtle nuance, right? And some of that can be seen here. So tech, still very much in an uptrend, right? This is up and to the right, higher highs, higher lows, above a rising 200-day moving average. For all intents and purposes, a textbook definition of an uptrend. But what I will say is this, still extended, right? Remember back in early September when the growth theme was extended and we were talking about it? I mean, that goes to tech too. It was extended and we're still extended, right? Above the 200-day moving average. So the consolidation continues to play out. The question is, which way do we resolve? I don't know the answer. I know what I'm looking at. Obviously, this trend being part of it. Maybe the situation is continue chop until the 200-day catches up and then up again. I don't know. But for me, it's hard to chase right now. It's hard for me to chase extended themes when the market is closer to overbought, when we have a lot of choppiness from a headline perspective. I just would rather wait for my pitch. You can see it playing out in the RSI of the ratio. It's right in the middle of the road, so that confirms. And on an absolute basis, still kind of a consolidation, a slightly lower high here in the near term. Now, one of the things that I touched on my note today that I don't go into detail here is rates. You've heard me talk about the curve steepener. Rising rates. We have to start thinking about if they do back up, what does that mean for your growth theme? It's probably negative, especially the high multiple growers, high multiple on the come stories. If rates back up, those are going to be susceptible. So just keep that in mind. It's something I'm watching closely here. Cyclicals, on the other hand, we've talked about this a lot. Where do you want to be? Well, we'd rather be in the industrials and the materials, the top two charts, as opposed to the financials and energy looked at on a relative basis. You should clearly be able to see why. We have the industrials, nice consolidation on the verge of a breakout. XLB working higher. We've been bullish on this theme for a while. We've been haters on the fins. I thought earnings might be a catalyst. So far, they haven't been. And we've been haters on energy. Largely, both of those have been the right call. So if you're looking at the cyclicals, make sure you're looking in the right spot, industrials and materials over fins and energy. And finally, I'll leave you with the question I've been asking myself, why? Utilities on a relative basis. If this strength continues, we have to start to look into it. Take us for a test drive, folks. That's it for today. I'm going to be back tomorrow. Have a great Tuesday, everyone.